Hi, everyone. This is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I think he's one of the better macro thinkers in the alternative media. He was a former executive at a Fortune 500 company, and he also has a popular newsletter. It's MATA SII, which is an abbreviation for Macro Analytics and Technical Analysis. Gordon T. Long, thank you for joining me again.
Thank you, Jason. Always enjoy our conversations.
Now, Gordon, we live in very interesting times now. You know, some of the data I look at, we've had a dollar rally since March, a very strong dollar rally. It seems that the stock market, whether it's a lot of insider selling the last month, I think over $10 billion, according to Charles Biederman of Trim Tabs, there was insider selling of shares, record high share buybacks with debt, but the insiders are dumping their own personal shares. And the stock market in the US is at an all-time high. In contrast with that, is that all the other major stock markets, the major ones in Europe, the major ones in Asia, they're all below 50 and 200-day moving averages. So why do you think the stock market keeps going up in the U.S. only compared to the other countries?
Quite a number of various reasons, but the most blatant why it's not at this point failing quite strongly, and as you correctly point out, at least closer in line with what's going on around the world. All the other markets have been down for quite a while, actually since January, and in some cases, in many of the emerging markets, dramatically. So our market just completely stands out. Now, for years, it's been pretty strong. It's been about quantitative easing and just pumping the sheer liquidity pushed into the market. And then, of course, we've got a flight to safety coming out of the emerging markets. They've got dollar debt, so they're having to buy dollars to maintain their debt, or at least pay the fig on it, if I can call it that. And so then they buying into our market too for the foreign investors that want to get in. But it doesn't answer the real question. Why is it not going down right now? And I got into this 2 years ago, Jason, because I really believed, even though I was doing a lot of work on the buybacks, I says there's the monetary policy, a lot more to it than just that. And really it comes down to this. It's about the pools. And by pools, I mean, we need to understand in simplistic terms, there are three stock pools. There's the stock pool of the listings. That is the number of publicly traded companies that are in America. The second is the total number of outstanding shares that are out there. And there is a difference, but as companies buy back, you're not changing the numbers of listings, but you've been changing the outstanding shares quite dramatically. So there's that pool. And then there's a third pool called the float pool. And the float is what stocks are actually available to trade once you take away all of the restricted stocks, for example, insider trading, et cetera, that cannot be traded. And we went changed to a float adjusted market capitalization system in 2005 and have changed it rapidly since. Now, that's just so we understand the three. Now, to put it right into perspective, let's talk about the first one, the listings. And I think most people are shocked at this. 20 years ago, 1996, we had 8,025 publicly traded companies in America, Jason. Today, 2016, 20 years later, I'm using 2016, it's even worse since, but 20 years later, we have 4,333. That's down half, 46% less companies out there are now trading or in the public pool than we had before. And that's because of mergers and acquisitions, no IPO replacements, but significantly the private equity moving in and buying out the shares, taking them over or taking them private. You know, and that part of that was the run up we had to the .com bubble. But I went back 40 years, and in 1976, we had just under 5,000 publicly traded companies. So in 40 years, we're still down 27%. You can't reduce the numbers of listings that dramatically and not have stocks go up. This is simply a supply versus demand. Now they're going up, they're huge demand, but the pool is smaller. So we have that issue. But now let's go to the second pool, and that's the outstanding shares. And now we're talking about the buybacks. And I suspect all your listeners are very aware of the degree of buybacks that have been going on. But in the last 5.5 years, it's over $3.5 trillion. And this year will probably come in close to $1 trillion. That in addition to that, we've taken out of the market in that 4,333 available listed companies. Now, if that's not bad enough of this shrinking pool, the bigger issue might be the float. When we changed the float in the market subtly with almost no announcements to float adjusted, it was actually a relatively good idea. But as we've now got to the point, if you look at and you have to actually pay to find out what the float is, by the way. It's that difficult and is working in real time, because the list of people that are now classified, or institutions, whether they're fiduciaries, whether they're insurance companies, or anything else where they hold them for a period of time, or they're in some way associated with the company, the list is actually dramatic. And so when you put all of these people that are now in the restricted pool and take out the float, there's another $1 trillion that's now been taken out since in 2016 was the actual number I went through just for that 1 year. So if you start totaling that up, Jason, that's we're getting up into $6 and $8 trillion of disappearing stock. Did I make sense there, Jason?
Yes, you did. And if I could add to your points, there's a lot more stuff there that really doesn't make sense for why the stocks are rising. So, if there's bad news, whether it was a Hurricane Florence, the stock market went up.
Oh, yeah.
So the stock market, in the past, Gordon, it seemed like common sense and logic. If there was bad news, people would react. They would sell off stocks. It seems like if there's bad news now, stock market just shrugs it right off. It's irrational, keeps going higher. The volume for the stock market continued rally has been very, very low. So the high frequency trading programs are not doing what they were supposed to do. Weren't they supposed to increase volume and provide us more liquidity?
Well, now we're getting into the high frequency trading, dark pools, and all this passive investing that's going on. We don't have the liquidity in the stocks. In actual fact, so if the Swiss bank, which is central bank, which is what are they holding now? $86 billion worth of our shares, and they buy just a few. The stock market's going up, and they're what are they coming in around 5 to 8 billion a month right now, or have been, or at least were earlier. Now we get to the Japan, we've got the Japanese. What do they own? 70% of all the ETFs, and the top 10 they own 40%. That is the Bank of Japan, and we could go on. So there's a lot of money that is just government money, if you would, central bank money that's going into the stock market right now. And it doesn't have to be large amounts anymore. And it answers your question directly. That's why when things should go down, they're not. I mean, we have never seen a market more overpriced by any measure than right now. We couldn't see worse economic numbers in terms of slowing around the world, though I will fully say the market in the last, since Trump enacted the Tax Reform Act, we've had a sugar high, which has really helped here. But it's not the public that's buying this market, Jason. It's not the institutions that are buying the market. They've been actually getting out. Even the private equity is getting out. What's buying the market is passive investment, specifically ETFs that are buying the index. There's no judgment in it. It's just they're buying the index and they're going up and it stays on it. It's like why the FANGs are going up right now. This doesn't mean, in spite of everything I'm saying, it's going to keep going, Jason. It never does. Something will change in here, and it could be a number of reasons.
And those indices and those indexes are market cap weighted. So it becomes a self-fulfilling prophecy, becomes a positive feedback loop. So if Apple and Amazon are going up and people start putting more money into their retirement accounts, buying index funds, well, then guess what? Apple and Amazon, the index fund manager buys more shares of Apple and Amazon.
Bingo, you got it. Now, this has been beautiful, but understand what happens if this goes in reverse. You will have a great liquidity crisis of the magnitude we've never seen before, and more so maybe in the bond markets that's now trading without any liquidity, and it'll take the stock market with it. I'm not saying that's imminent, but I'm saying that's the precipice we're living on, and that's why the stock market no longer makes any sense. And there's more to it in terms of what's the shift here too, Jason, because the accounting, it's not manipulation. The accounting methods we use for stocks today, our accounting, is obsolete. It's an actual fact. It works as a disincentive, and basically, it's about how we treat tangible assets. So if you're buying a building, that's a tangible asset. It's an asset. It's on your balance sheet, and your profits aren't affected really by it. Theoretically should be making profits because it's an old industrial capitalist based system. Today, it's all about intellectual property. It's about innovation. It's about cycle time. It's about software that as soon as you put it on your books, you can write it off to some degree, but you can't put the asset on their books to any real degree that you can. For example, how do you size what intellectual property is worth? How do you determine what the value is that you have platforms of software that you can keep changing and recharging? And you know how many times you're getting recharged for software nowadays, and because you've got this platform with no costs in it. So you've got all of that's going on. So there's a de-incentive for people to go public today. If you're privately run or public, if you wanted to go public, an IPO, you're facing all the issues with Sarbanes-Oxley's, disclosures, legal suits. And you're talking to a guy that knows this, Jason. I swore after I had a publicly traded company, I'd never go there again. I was spending 3 out of 5 days with legal litigations of green mail being shaken out, whether it was interrogatories, depositions, testifying, doing the research, meeting with lawyers, et cetera, et cetera. And I never lost a case because none of them were of any. They were just fictional green mail, shake you down. And if you have a publicly traded company, every CEO knows that. Additionally, do you really want to start talking about your software and what is your intellectual property, your strength? Because now you're divulging your secrets. You're really starting to let out more than you want anybody else to know. And so that's not happening. So what it's doing is it's changing the role of the stock market. The stock market is no longer about a method of raising capital. It's really it's because when the IPOs, they're not happening, but they're being funded by private equity that it's coming in and buying them.
Plus, Gordon, if I could add to your points, or sorry to interrupt you, but I think also the stock market, where you said it was to raise capital, now it's being used by insiders, by private equity, angel investors, and corporate insiders to dump the shares.
Exactly.
So, yeah.
Exactly.
So when it goes so the public, the retail investor thinks, oh, I'm going to have access to this hot IPO. There's going to be a lot of growth ahead. But that's, in a lot of cases, that's not true.
Yeah, it's a setup. What we have in the market now, the exchange traded markets are going through a debt for equity swap. And so if I have from reliable sources that private equity now control 60% of the S&P 500, either outright or because of the amount of control they have through the debt that they're also putting into these various companies. And remember, anything that they have as equities taken out of the float pool. So that what's happening is they're loading these companies up on debt, buying back the shares, earnings per share are going up, drives the indexes in, but as you correctly point out, everybody's taking their money out. Not just the insiders, but are the employees and that sort of thing that have stock options, but the major investors that are going in it, for example, the private equity. And and I keep mentioning private equity here, Jason. People don't understand that the top 4 private equity guys right now have a $1 trillion of investable funds. That altogether, there's $20 trillion in private equity. And it's sitting there behind. So they have taken over the role of what used to be venture capital, secondary offerings in the market, because they're the ones bringing in the debt. They're borrowing the money, plowing it in, driving up the share prices that go with it, but they're really just sucking the money out. Now, remember, if the stock market was to go in reverse because of this liquidity crisis we were talking about earlier, the equity guys get wiped out, but the debt holders in the senior secured, they're just fine, because even if the company's failing, they still get their payments. And if it goes into bankruptcy, they still get the assets. So they'll skin out some of that, whatever the real value of the company is, and take it and move it somewhere else. So their downside risk is not there. The risk profile that the passive investors are now taking on unwittingly is massive in proportion to really the gains.
Yeah, I think the index fund
I don't mean to be
investing,
that simplistic.
I think the index fund investing, the passive investing, it's definitely a bubble because there's a lot of people putting money into their retirement account chasing the stock market higher and higher. But, I think this ties in.
But
Sure.
Jason, that's the stock market. And you're absolutely right. But it's orders of worse in the bond market, because there's no liquidity by the nature of the bond market. That's the make to market was the whole role of the banks, but that's all been changed since we went through Dodd-Frank. Their prop desks don't handle the bonds. Wait till you've got all these indexes that are going to say, okay, we'll sell the bonds. They can't sell the bonds that are part of their index. They can't. They won't be able to unload them. And not only there won't be the liquidity out there in the people that are buying the bond market, never mind in the market itself. So that's the most terrifying. And if there's as everybody talks about the stock market, but the 600-pound gorilla, 800-pound gorilla is the bond market.
Well,
And
Gordon,
the good news is no matter what, they'll print the money because the Fed and whatever will protect the bond market.
Well, for the U.S., yes, the U.S. can get away with that. But in this transition, one more point about the stock market, but this is going to transition also to our next topic about emerging markets and also the dollar, is that I'm seeing a lot of evidence. I know you study financial history. I study it as well. And what I'm seeing, Gordon, is a lot of things very similar to the last couple years prior to the October 1929 stock market crash. And we're seeing, that the thing I mentioned earlier in the interview, in the first question there, about the all the other major stock markets outside of the US that are below their 50 and 200-day moving averages, that shows to me that all those other economies, major economies, and their stock markets are reflecting reality and are in either major recessions and or depressions. And that's very similar if you go back through financial history and look what happened prior to the October 1929 crash, because what happened then? Tons and tons and tons of flight capital came to the United States then. Yes. And you're seeing tons and tons of flight capital, whether it's from Asia or Europe, come to the United States now and chase, whatever market is still going up, also into real estate. I mean, there's tons. I'm sure you've heard these stories too from your friends, Gordon. Tons of anecdotal evidence of, Chinese money coming into major cities, not even major cities anymore. I've heard, second tier, third tier US cities, but like just ridiculous anecdotal stories of people grossly overpaying for real estate and also, into bonds. So there's a lot of flight capital really for 10 years, but it's accelerating, that has come into the United States now as well, especially into the larger cap stock markets and real estate and bonds.
And use the key word there. I fully agree with you, Jason. The word I would stress is accelerating. It's not over. It's only beginning. This flight to safety, as bad as the U.S. dollar is, and I could go on about it. Right now, it's the least ugly at the party, and it probably will be the last to fail in what I believe will eventually be a realignment of fiat currencies. But the big issue, as you mentioned, in the emerging market here is a phenomenal big problem. And in 2003, 2015, we did a lot of work, and we said there was going to be a massive, what we called echo boom. And that was, there was a bubble appearing because of quantitative easing. And then it really started to take off in 2012, 2013, with quantitative easing was now full bore. And now Europe started doing it after its banking crisis. And all of that hot money, that cheap money, went to the emerging markets. And the reason it went, well, there's a number of reasons it went to the emerging markets. But a big part of this is, what was quantitative easing and all about? It was about bringing demand forward. We made everything cheaper so we could stimulate demand. We can question how much it did. But what I believe 9 out of 10 people don't appreciate, it's not about bringing the demand forward. And by the way, when you bring demand forward, by definition, you've created a hole behind it, or a vacuum, where it's not going to be filled potentially. And so that's where you all of a sudden can have a going down. Where I'm going on this, that's demand and this big hole. What happened, all this hot money went to the emerging market and exploded supply. If you've traveled around the world, you will be stunned at how the whole supply chain has built out through all of the emerging markets, whether they're on the commodity end, the low end of that supply chain, right up to component levels. You look at China, its GDP is as massive as its exports are. its imports are not that much smaller. So it's not the major part of its contribution. It's capital formation. But the magnitude of those imports that are coming into China are coming from the emerging markets. And that was the money that went out. They borrowed well over $9 trillion in US dollars alone. And now as the world is slowing, that hole I referred to, as we've taken away quantitative easing, we went to quantitative tightening, and there's a direct relationship with the emerging markets falling and the end of taper. The currencies are now in big trouble because of the current accounts are negative and their currencies are collapsing.
Plus, if I could add to your points there too, Gordon, you have the rate hikes.
Yes.
So you have the Fed is hiking rates now, and even though they're a quarter point, a couple of these things do add up, and on a relative basis, that looks more attractive. That looks more attractive to people who need a yield in the short term compared to emerging markets. So they view it as, I can get less risk here in the U.S. and still get a return, even though people aren't counting real inflation rates. The real inflation rate's a lot higher than the return they're getting on bonds anyways, though. But they're still viewing it as.
You're absolutely right there, Jason. The only caveat I'd put on it, if it wasn't for the real strength of this U.S. dollar, the amount of money would be coming in would even be dramatically larger. That is coming into our U.S. bonds. They're not buying our bonds right now. And the reason they're not buying them, and they should, is because the hedging cost is too much in the U.S. dollar. The way you make money on a carry trade is you want to borrow money, and where the currency you're going to pay it back is falling. And so the carry trade right now is temporarily restricted. But if the dollar starts to weaken here in any way, the carry trade will start to accelerate because suddenly their carry cost changes and they'll come into the bond market. But right now, as you correctly point out, that money that's coming in is primarily going into assets other than the bond market, whether it's housing, other fixed assets, or in some degree the stock exchange.
Yeah,
but on this echo point, just one other point here, Jason, that I think is really important. We all talk about the growth in debt around the world and $233 trillion. We're all heard the story for years, and we've watched it in terms of government growth and personal debt. But in actual fact, when you really look at the debt, and I've torn it apart, the debt growth has been in corporations. The corporations are the ones that have been exploding in their debt growth. And for obvious reasons, for the American companies, they're doing buybacks, borrowing money to do the buybacks. But if you get into the emerging markets, the emerging market growth, or where that growth in the debt has been dominated in the corporations, their companies that are more. For example, in Turkey right now, if you look at where the Turkish have spent their money, it's been in all sorts of infrastructure and corporations to fund them. So what you've got now is you've got this potential, in many cases, of zombie corporations whose revenues and profits, their EBITDA, their free cash flow, can even no longer match their expense on their debts that they've put in. And matter of fact, right now we have 10% of all corporations in the world actually qualify as zombie corporations, according to the Bank of International Settlement. And 20% of all corporations are considered, I won't use the word impaired, but challenged is I think the word they're using. That's just right now. Now, if this keeps on going, you can see where the real crunch and the breakdown will be. And it's starting right now in the emerging markets. And remember that the emerging markets, they've borrowed most of their money is really out of the European banking system. The European bank, all South America.
But they did borrow from European banks, like you said, Gordon, but they did use US dollars for their borrowing because that was cheaper. So it's kind of like a teaser rate. So they're betting that their currency would have appreciated against the dollar and that the dollar would weaken. And as we've seen pass through past financial history and banking panics, whether a couple decades ago, whether it was the tequila crisis or the Asian tiger crisis, that, these things can blow up.
They will blow up. Now, this will blow up because right now we have a euro dollar shortage, a massive euro dollar shortage. And that is exactly what you're referring to, because if it put all their money in US dollars, not necessarily coming to the United States, they've transacted their loans in US dollars or the euro dollar. and there's
Exactly.
a
Yeah. So
shortage of them.
well,
And the United States government, last time we got into this, we issued about $600 billion to Europe, and the financial or during the 2012-13 EU crisis to do swaps to kind of liquidate or put enough liquidity in there, because all these European, you go through South America, all the big banks are the Spanish banks, the Portuguese banks, the Italian banks. Go around the world in emerging markets. Those are the dominant players, or some form out of the European markets. Yeah, we got some British banks, no question, some of the old colonies, if I can call them that. And you see the American ones occasionally. You see European banks, and they're the ones that are on the nut for this. And in my mind, the European banks are the absolute worst structured banks in the world. I don't think they can handle this problem right now. So I'm expecting this emerging markets problem to very quickly wash ashore in the EU.
and you mentioned zombie companies. Well, I would argue that European banks have been zombies since 2008. I don't know if you listened to Jeffrey Snyder and his seasons 1 and 2 of the Eurodollar University on the Macro Voices podcast, but he does an excellent job there for our listeners. I've been telling our more advanced listeners to the podcast to go and check that out.
It's mandatory listening. He's one of the very few people, Jeff, that really does understand truly the magnitude of the Eurodollar problem and what's going on, and how these banks have created the Eurodollar out of thin air. Global bank, because there's absolutely no regulations, no rules. It's just wide open heyday for them, and it's been going on. But now they're caught. There's not enough collateral to support it.
Well, that's why the U.S. has been secretly, the Federal Reserve has been secretly bailing out the European Central Bank, and they've been doing bailout like with currency swaps with the European Union governments and European banks for years now, many years now. Really, since 2008, it never really stopped. We know from the one-time partial audit that Ron Paul got that a ton of bailout money, around $16 trillion, there was the one-time partial audit the Federal Reserve and its lawyers were fighting this, was given out at the height of the crisis in a very short amount of time. A lot of that money actually went to Europe. But, they guaranteed, as we know from the Eurodollar University, the European banks guaranteed a ton of commercial paper, thinking, and other mortgage derivatives, thinking that there was no way that they would pay. But you talked about a dollar shortage, Gordon. I've heard a lot of
a euro dollar shortage.
Well, I've heard a lot of people say dollar shortage, but I think it's more important that we just say that these politicians in these emerging markets and a lot of people running corporations in these emerging markets, they were very irresponsible borrowers. Okay, I think that's the right way to phrase it, rather than saying there's a dollar shortage, because they were gambling that even though they knew in the long term they were going to have real trouble paying the money back, they gambled anyway, betting that they would figure out a way, and they took the money up front and said, you know what, I can't pay it back, I'm still going to take the money.
Yeah, we all get into this problem because of just lack of fiscal responsibility, and politicians, too many populist politicians, and that's the problem with fiat currencies.
So since you've worked at large corporations, let me transition here to another question. Since I know you've worked at large corporations and you've run some, so I know you've dealt with international trade. I was listening at the gym to Bloomberg Radio for a couple minutes last week or the week before. I forget, it's been a while. But they did mention in the 5 minutes I was listening to it, because I don't really like that channel that much, but it was very interesting. And they said that large corporations, multinational ones now, are reporting that due to the President Trump tariffs and the trade wars he's having, that some companies, Gordon, just in the last couple months are reporting that their costs are going up 25%. So I know you've talked about people now are getting, less goods and services, either with devalued currency for more money. So they're having to spend more money to get less.
Which corporations are saying their costs going up? U.S. corporation?
It's yeah.
Or European or Chinese?
I think it's becoming pervasive now, man. I think,
but you're right. You're right on that. But we got to be careful. We talk about whether it's trade wars or supply chains, because we're putting on tariffs, but it doesn't. When we put on a tariff, it's not driving up the price for our producers here. It's only a counter tariff that if they're having to buy a good from another Europe, for example, like China, and a tariff has been brought in. No, we got a lot of people taking advantage of a situation right now.
Oh, really? So you're saying then that
No,
the
I'm not
people
saying. I'm
who are
saying that's part of it. That's part of it. Okay, that's why I'm saying which companies are you talking about? Because they all have slightly different stories and motivations of why they're doing it. But
well,
trade will drive up prices. Trade wars will drive up their cost of goods. But right now we don't have universal trade wars. You know, China has not put on that many tariffs on our products. Okay, unless we're really getting into some core elements in steel or aluminum or whatever, but they haven't retaliated. Europe hasn't really retaliated right now to any magnitude that really would drive up the costs. You with me? Now are they anticipating it? Absolutely. Are they reacting to it? Yes. Are they starting to reflect it in what they think their potential earnings are going to be? Listen to the conference calls, and that's what they want to talk about. Of course, a little bit of that's a smokescreen because they're having trouble sustaining because revenues are not growing and free cash flow is falling. So they're kind of weaseling around in here. But I'm not trying to take away from it, but it hasn't hit yet. That's what I'm trying to say.
so you're saying that the reality is that the tariffs are not doing as much damage as some of
Yeah,
these corporations are claiming.
yeah, exactly.
Also, the famous small cap value investor Eric Cinnamon,
And I think,
who
and
was
sorry to keep interrupting you, Jason, but I also believe that Trump and his team are fully cognizant of that. And I believe they know the delay that it takes for this to work fully through the supply chain, even though they're starting to react in advance. They're hoping that they will get these things settled sooner as a bargaining chip to really get some of the things they want in place through the trade negotiations. That's still a question whether they'll be successful. And all of the hype that Trump says, "Hey, we'll win this, we'll stay in it." He knows he's only got a limited time. He can win the trade war in the long term if he's stuck with it, but the population will turn against him very quickly, because what you need to really appreciate is that tariffs in the United States are a tax on the U.S. citizens. When we put a tariff on of 25%, our costs to us, the consumer, will go up 25% on those products that we were importing, and we import almost everything we use. Okay, right now. So when that starts to hit the consumer, that's when any president will have severe problems.
thanks for sharing that. So
Does that make sense to you? No, I'm talking as an old guy that spent a lot of time worrying about transfer payments and transfer costs and all of the issues associated with dumping between countries, and what my costs could be and what I could justify to the government between countries. And that is a massive issue right now. You build something in one country, what is its cost that you want to send to another country? And you can change the costs associated with what you want the price point to be and where you want to take the profit.
Well, in general, I just remembered my point because I had a little brain fart there. But in general, I think really the large groups of people, really no one wins a trade war. There might be individual companies or individual groups, small amounts of percentages of people that are either connected to the government or lobbying for specific protectionism stuff may win. But I think overall, like Chinese citizens who are trying to, get out of poverty or go into an emerging middle class, they're going to get hurt if they want American goods. And people here in the United States who are maybe barely getting by, don't have a high paying full time job, they're probably going to get hurt if this trade war escalates and continues.
Yes.
But Eric,
it'll be destabilizing to China. It'll be destabilizing to Trump. This is not, you'll have socialism and a move to the left like you won't believe if it's really sustained for any long period of time, because it'll be turned against them. But we're
already seeing evidence of this, Gordon, with the midterms, right? So
clearly.
This is what, so they're running TV commercials, even Republicans who are never Trumpers or anti-Trump. There's still a block of that. And they're obviously the Democrats, a lot of them are in the resistance and they hate Trump. And so they're recording farmers, right, that have gotten hurt by these tariffs, right? And so they're running TV commercials that are anti-Trump based on that.
Yeah, and your point valid too. With the only ones that I know are getting hurt right now are the farmers, because the Chinese have been specifically targeted at soybeans and food product.
Well, value investor Eric Cinnamon, Yeah, soybeans and pork are two of the main crops right now that are getting hurt the most. But top value investor Eric Cinnamon, who at one point was the top rated small cap money manager, he listens to 300 conference calls of companies routinely, spends a ton of time doing this. I don't really know anyone who does this amount of research work, and he's not even getting paid to do it right now. He's going to get he's waiting. He's actually in all cash right now because he's a hardcore value investor and he's not buying any stocks. He's waiting for the cycle to turn and everything to crash, and then he's going to go buying like crazy. But anyways, though, he listens to all these conference calls, and from what he's been gathering, there is a lot of inflation, higher costs going through the supply chain, whether it's tariffs or just in general inflation with more demand for certain types of goods over the years and people's costs rising, not through tariffs necessarily. But what he said is that these companies, Gordon, their margins are intact because they think they're going to be able to raise prices. So as long as that, the companies are not going to get squeezed too bad, but the consumer, like you said, that's going to be stagflation for the U.S. consumer. Then they're going to get less for more.
Yeah. Remember what capitalism is you get more for less, but when you get socialism, you get less for more versus more for less in capitalism, and so they will get squeezed. Then that's no question what's going to happen to the consumer. The point is we have a return of pricing power. Right now, currently, there's been complete lack of pricing power for almost a decade. And now we're having some upward pressures on labor because of the shortage of labor, of specifically skilled labor here in the country. And so those are valid comments. But it's not going to last. This is a 6-month maybe kind of phenomenon that we're going to see. A big part of this cost push. I listen to a lot of conference calls too, Jason, but I pay a lot of attention to the ones that are down in not the end user corporations, but the ones that are suppliers of raw finished goods, our components through finished goods. And so the emerging markets, because of the squeeze we talked about, the slowing down of the amount of trade, and there's no question global trade is slowing down. If you're a corporation and it's slowing down and you've got certain fixed costs, what are you going to do? You're going to increase your prices. You have no choice. And so they're pushing their prices up. They're coming into China. China's trying to figure out how to absorb it. They're pushing the best they can. And so that push is pushing itself because of these rate changes and the US dollar back into America or into the consumption economies. That makes sense to you? It's a supply. The whole issue is the overbuilding of supply. There's too much supply out there, too much overhead, too much cost that under overcapacity that can't be absorbed, and they're pushing it in. So that's why we have price push right now.
Yes. Well, the central banks have provided too much liquidity, too much money and credit. And so, at some point with all that monetary inflation, the extra money and credit floating around, I think there's tens of trillions of dollars in extra money and credit floating around since 2008. China has an enormous credit bubble that's grown in the last 10 years. There was bound to be, excess capacity, like you said, malinvestment, as Austrian schools would say, and then inflation in certain things. And we're,
$26 trillion. $26 trillion US of money that was created and is floating around out there. You're vehemently correct on this, Jason.
And as usual, Gordon, the Federal Reserve is behind the curve. So David Rosenberg put out a tweet yesterday. I kind of call him the most rational Keynesian I've ever met, because he looks at the data and he sees different things than a lot of these really hardcore brainwashed Keynesian ideologues that a lot of the mainstream economists are. And what he said is, the Fed doesn't realize they're talking that there's no big deal with inflation, but over the last 2 or 3 years, he's talking about there's massive increases in inflation in a lot of the Fed's own data.
That's correct. They always show us the PCE, the consumption expenditure is their neutral rate that they use, but even they've got data out in the Fed, and I forget which one of the Feds, it's New York Fed or the Philly Fed, that shows that inflation is much higher. And then we get into what Shadow Stats and John Williams has, and we know that it's been running 8 to 9.5%. But on any basket you look at, it's much higher. But even if you accept the Fed's numbers and don't go off the deep end, the Fed is not only behind the curve right now, they've got their head they're banging up against a over leveraged environment that they can only go so much further. Right now, if you look at the PCE, it's if I recall, it's 1.99, and the Fed funds rate is running right now the nominal at about 191. So we're just barely below that neutral rate. If we go to the next Fed funds increase, and let's assume, and I'm assuming right now 2 more increases, and then that's it. But then if we go to the next one, suddenly the Fed's fund rate is then greater than the neutral rate. Now let's assume that the inflation, their PEC goes up and gets closer to the reality out there. Because I'm not talking about reality here. I'm talking about the degree of leverage that's in the system. And if you go back and you look at 30 years of the Fed rate, you will see every time that the Fed's fund rate climbs above that neutral rate for any period of time, a few months, we have a major financial price crisis somewhere in the world, whether it was the Mexican crisis, the tequila crisis, the Continental Bank failure. I mean, it's always the same story. Then if you overlay the 10-year bond and really look at the long term, the control channel that it's in right now, if we break 2.5%, 3% actually on the Fed funds, or the 10-year bond, then in fact it breaks a channel we've never broken before. And so the combination of the Fed's got a real problem here, because they want to push it up. They know what the real inflation is, or they suspect it's much higher. They see the squeeze that's going on with labor right now, which is really problematic. They've created their own problem. So they're playing with fire. And I guess what the point I'm making, everybody that's in all the financial institutions that are so highly leveraged, they know that and you can see it in the long bond. It doesn't move because that yield curve is about to invert. That 30-year has not changed at about 3.09 all the way through that. That says that they really see the economy is going down, that it's slowing, and that the Fed is going to have to reverse pretty soon. Probably because we'll see a recession sometime next year, maybe in the following year, but I've got it currently expecting it sometime mid-year, and we discount forward. And the Fed's going to have to reverse, and they will have to get off this quantitative tightening, and we're back to something else. Because as I said at the beginning, Jason, never forget, they will print the money. Whenever there's a problem, they print the money.
Or change the rules, or change the accounting rules with the banks, right?
So, and by the way, that in itself is a massive story of who's buying the bonds and the incentive the banks have to do it, and why all the reserves are so high and the amount of money they're making. It's actually criminal. But now we're into the whole concept of financial repression and how it's being used to try and keep this whole game together right now.
And what was a head scratcher to me recently is Lael Brainerd, who's one of the governors at the Federal Reserve Bank. She recently said that even if the yield curve inverts, that the Fed would still hike rates.
Yes.
So, that's kind of that means they would exacerbate it, right?
That's right. But I say 2 more. A lot of pretty smart guys are saying there's going to be 2 this year and 2 more next year, not the 4, before she breaks. They don't stop until it breaks. I've been in this business a long time. I don't ever remember them stopping before something broke and they were forced to. It's almost like that's the strategy. They just go until it breaks, and then they say, we can't go any higher. And by the way,
that is true. That
peak keeps going down and has been going down for 30 years.
Yes, they do hike until something breaks. But now, Gordon, unlike in the past, now they have a legitimate scapegoat. They have President Trump, right? Because when he was running as candidate Trump, he was saying the stock market's a big fat bubble, and the stock prices were way lower. The general stock market index, I think, was on the Dow was 8,000 points lower.
I can't believe that he was so stupid to get caught in that trap.
Well,
he should not he should not try and take any responsibility for this stock market. He shouldn't be. He should be trying to take claim for the unemployment rate, the growth in labor costs, et cetera, the amount of people that are now being employed, how the welfare rolls or these food stamps are falling off. There's a lot of things he should, not the stock market, because they are going to make him eat that.
Yep. Yeah, so it's either hubris on President Trump's part, or maybe he's playing some type of 4D or 5D chess that
Well,
we
let's
don't
hope
know.
so. Maybe. I don't know, but I was shocked for him to be so stupid. But on the other hand, remember, Trump believes he's the king of debt. I had money in him when he had his casinos because I've watched him a lot for a long time, and he really believes the way to anything is just leverage beyond anything imaginable, and you bet it all. And he will put pressure on the Fed to take down rates or to weaken the dollar in some fashion, some way. I really believe he'll do that to save his own skin, if nothing else.
Well, I think every politician and every government economist who's a Keynesian and all the major economic and political elites who are running things at either central banks or major governments and major economies, and the people who are advising them, because obviously, Gordon, you and me aren't advising people who are running these central banks or economies, or advising the politicians, but it seems like they're all preaching out of similar playbooks with mercantilism. So Keynesian economics is based off mercantilism, and so when in doubt, you devalue the playbook. I'm not saying this is right. I'm saying, but this is what we know through history, is that they devalue the currency.
Always. That's the problem in Europe, that the individual countries like Italy, et cetera, can't devalue their currencies because of that's the whole flaw in the whole European market. That's one of the reasons why I think there's going to be, as bad as the issues are in China right now, and they are bad, and as bad as the economics go around the world, we were just talking about, the one that's not getting the visibility yet is Europe.
And President Trump was talking about buying Italian government bonds. I mean, we already know. Yeah, I mean, I literally put my hand over my face like facepalm when I heard that. I was like, we've already been bailing out, helping out the European Central Bank, bail out the European banks for years, and now we have to do this. I mean, things must be a lot worse than they're telling us.
They are. And so all we'll do, as I said earlier, they'll just print the money. We'll print the money, or we'll issue swaps, and we'll keep this game going. And that's what we really, as bad as negative as we can be with some of the reality here right now, they can keep this going for more time, Jason. That's what everybody seems to underestimate. I don't think we're necessarily, right on the precipice. We'll have a few scares like when we did in the end of January with the volatility implosion, and we're gonna see that. But I think there's some more games that can be played here. There's more with a monetary standpoint.
I completely agree. Yeah, I was saying rule number one, I've been saying this for years, that rule number one is they can change the rules anytime they want.
And every time they do. Every time. And I was in a discussion the other day, and I had to explain to somebody what mark-to-market was. And the way we got out of the 2008 financial crisis, and everybody forgets this, amongst all the facilities we put in place, we changed the rules in the bank. We said you don't have to mark-to-market. That changed everything in the derivatives world and the options world. It never has been reinstated. It was supposed to be just temporary, right? And I've got a series of charts of where we've changed the rules, and we do consistently, and we will change the rules. We always do.
And meanwhile, as I agree on the rule changes, and meanwhile, there's dozens upon dozens of economic landmines that are $1 trillion in size or larger. There's leverage short volatility trends, not just in stocks, in a lot of other asset classes now as well. And, things just seem to get crazier. And I think, Gordon, one of the major reasons that they will be able probably to get away with these rules changes, and you can chime in on this, is that we're in the minority. You and me, we're highlighting the things, the truth, the reality of the situation in a lot of aspects. But a lot of people, regular people on Main Street, they don't have time to study this. They are putting food on the table. They're busy with their job. They have a wife, kids, all the normal stuff in life. And so, they mostly care about if my house price falls or if my retirement account falls. They don't care how or why something goes back up. But if it goes back up, they're happy. So I think there's a level of complacency that people can rationalize almost any type of behavior by the economic and political elites, as long as, their home price doesn't go below their mortgage, they have like a positive equity in their home, and their retirement account looks, like it's going up.
Exactly. There's no question. And the media and the politicians all pander to exactly that. That's why you can't trust anything that you're really told. You've got to go out like you do, I do, and do your own digging and your own research, and then you'll find out there's a whole different picture out there.
And Exactly, Gordon. And the scary part, and I've heard this on Twitter from people in Vancouver, is now you have politicians in Vancouver, because they want the home prices high. They know that, like, illegal Chinese money is being smuggled in, money laundering, drug money, to buy houses in Vancouver, and it's forcing out the regular people who've lived in Vancouver all their lives, and they've commuted over an hour to Vancouver. They can't find anywhere to pay rent, and I've just heard some horror stories from people. And meanwhile, the property prices on a lot of stuff in Vancouver is going like crazy, but a lot of the politicians there don't care, because those extra home prices, with the drug money and all the other stolen money from China that's come out and parked in Vancouver, the higher home prices means lots more property taxes for the politicians to run the government then.
It's cooled somewhere. I have a lot of friends out in Vancouver, West Van specifically, and I could bore you with the stories that I was hearing, but it has slowed recently. One Canadian laws that have put in trying to stop it, but it's all relative. I happen to think, just as an aside, one of the most exposed property real estate countries in the world right now is Canada. And it got through the financial crisis totally unscathed in 2008, if you recall.
Yeah, I think Canada and Australia have enormous real estate bubbles.
Precisely, both of them,
but in the major cities mostly. Although
only the major cities, specifically Toronto and Vancouver, and to a lesser degree Calgary.
I've heard a few stories from friends about Montreal, but yeah, it's nowhere near the amount of craziness I've heard from Vancouver and Toronto.
Yeah. So, but I guess we're getting a little off track. But as mortgages rates go up right now, you'll notice that, we're feeling it in the real estate. The number of new sales, existing houses, the number of starts, they're all starting to slow quite significantly, but not scary yet, just coming over. But it'll start to accelerate, and that's when we'll have some fairly significant pushback. I think that the thinking is that. That they will come off quantitative tightening before that happens. It gets too bad. But Powell's a different cat, and I'm getting a little off track, but I haven't figured him out yet. And I have a sense that he's willing to go a little further than any of the others have in terms of really being hard nosed about what he's saying. Though he softened, became a lot more dovish here in his last conference call. And I don't know whether Trump beat him up or what.
Well, Paul Volcker created a mutiny on Wall Street, and also the president. So Paul Volcker did do the right thing at the time by, raising rates and trying to protect the dollar. But, Wall Street hated him, and they eventually forced him out. But I don't think there's the ability for another Fed chairman to actually be another Paul Volcker. Even Paul Volcker said this recently, that, no one can go and hike rates over 10%, keep hiking rates like that. It would break something long before that. So in the remaining time with the interview, Gordon, what should people be paying the most attention to for the rest of the year, you think, then?
Credit cycle. You should be really paying attention to all of the indications on whether the business cycle is already turning. There's no question, but whether the credit cycle. And one of the areas you should pay attention to is in the spreads on the high yield bonds right now. And because I think that'll be the precursor when the high yields will start to go up. That'll happen before the Fed reverses itself. But also really watching what's happening with the credit default swaps. That was an old area that everybody's learned the hard way back in 2008. And they're just, I track them very closely, and it's quite dramatic, the risk premiums that are being asked right now, which is a sign that people are getting more and more nervous in the credit market. The changes will happen. The equity market is like the tail on the dog. It's the last. What happens is the currency market starts to kind of anticipate it and see it. But the brain really is in the credit market. The credit starts to really shift. And when the credit starts to shift, yields start to move and bonds start to move. And it's that area you need to be focused on right now to make your decisions if you're talking in the equity market. Because this thing could have a few little minor skirmishes, but we could be seeing an S&P of 3250. My call has been 3,050 before we actually went into reversal. I'm not saying that's necessarily going to be sustained because things are continuously changing right now. But where I've got my eye on, as I said, is really on the credit. I don't really pay much attention to the equity market right now. It's kind of a meaningless game right now. It's just, again, the tail on the dog. It's just being wagged.
And Brent Johnson of Santiago Capital, he had his milkshake video. He actually made some interesting predictions recently. He thinks that the Dow by the end of 2019 will be over 30,000, and by the end of 2020 will be over 40,000 if capital keeps flowing, flight capital keeps coming into the U.S. and the other central banks and credit bubbles in other countries, and then money escapes and comes here to the United States.
Exactly. That's why we started with the discussion about these pools and how dramatically they have been reduced. So the supply is a whole set of equations that we go through at MATA-SII. But what's important is the demand side of it. And the demand is not just about sentiment, which is at all-time high. It's really about how credit flows. And so it's about liquidity, credit, and flows. And liquidity is about the monetary drivers that are behind it. The credit is about credit and debt, the ability for people to take on debt and people willing to give credit. And that's a function of collateral and the values of the collateral. And then flows, which is the rate differentials between countries and in real terms, nominal terms, and the difference. We track all of that in what we call a liquidity gauge to try and understand what the real demand is. And we marry that demand up to the supply on the stocks that are really available to try and anticipate when that shift is going to happen. And that's the only way we've ever been able to, not get out too soon, because you can be out short the market and be broke right now, or you could be out of the market and you've lost gains that are of a lifetime, right?
And this could this could be another.
We could be quite literally at the beginnings of the Minsky melt-up, and that is this tremendous flight to fear, flight to safety, along with a shortage of stocks. That is definitely a potential right now.
And another warning sign, Gordon, is that now there is a new retail credit default swap ETF that just launched. So that thing's designed to fail. There's going to be immense tracking error in there, like those triple leveraged or inverse leveraged, those ETFs. I think two of the leveraged short VIX ETFs already, not only did one of them blow up in February, the XIV, I think two of them recently, from what I heard from one of my listeners, another two of those leveraged short VIX ETFs, they also shut down. So they gave people who were invested in those some of their money back and said, you know what, when the VIX blows up again in the future, and the VIX is only like around 12-ish now when we're recording this on Thursday, September 13th. Let me check.
We never learned a thing about shorting vol when we went through the crisis in January, because correlations are all back, et cetera. And as you said, the VIX is back. We didn't learn a thing.
Well, these leveraged short ETFs, I mean, they're using futures contracts, so there's going to be huge tracking error in there. So obviously a professional wouldn't use one of the leveraged ETFs. They would outright and go and buy the futures, right? So they wouldn't use the ETF. And so the retail investor wants exposure to this, but then it's not tracking properly what the underlying, the VIX is It wasn't the leveraged short VIX ETFs were not tracking the VIX properly.
Now, there's a whole discussion on how ETFs and how if they effectively mirror, and you have to have a trend before you actually get your money mirroring what you think you're going to get out of them. But we do not invest in ETFs.
And Gordon, you mentioned credit default swaps.
That's not saying you can't make some money. Just in the ETFs.
There's good ones. There's good ones and bad ones. So I would just be careful out there. ETFs are being sold as panaceas. Obviously, this is not financial advice. I have to do a stupid disclaimer now because two suits with badges showed up at my door, like trying to threaten me about this podcast. It was so dumb. But this is just for information and educational purposes only. We're only giving our opinions, not financial advice again. But
yeah, I stress that too. That this is just a discussion, because anything you say can be different next week, and so you can't make it. But you need to have a really good investment advisor counseling you and helping you. Unless you've been in this, it's tough enough when you've been in the market as long as some of us have been, and it changes. Unless you've got the tools, and I mean sophisticated tools. You can't. When I was talking about liquidity, our liquidity gauge, then understanding how much really demand and supply is out there. You're just guessing. You might as well go to Vegas. I think your odds might even be better.
On some of the stuff, yes. On some of the stuff, yes. Especially with very heavily manipulated markets, because some markets are manipulated more than others.
Are you talking about the gold market there, Jake?
A little bit.
Anyway, you were kind of wrapping up. I apologize. I didn't mean to take us off on another tangent.
Well, last point here. So you mentioned about credit default swaps. I've heard rumors that credit default swaps were an effective gauge because credit default swaps were obviously effective during the 2008 financial crisis, and you could tell when a company was in the most trouble. But I think now some of these CFOs, because there's so much accounting fraud and they want to manipulate things, that some of these publicly traded company CFOs are well aware that the credit default swaps are a gauge. So I think they buy some. I've heard rumors that some of these CFOs are smart enough to even buy their own credit default swaps, so to try to throw the market off from properly weighing out the credit default swaps and as an accurate gauge.
We don't have anything to do with company credit default swaps for many reasons, including what you just said. We only pay attention to credit defaults at the sovereign level. So when I talked about the changes, we actually look at all the countries around the world, and we group them into areas, and then we look at them on a quarterly basis, because it's not something you trade, and the shifts and the patterns and the trends. And it tells you what's happening with risk. That's when it's an effective measure. You can't trade it, but it's another one of about 40 thereabouts indicators that go into trying to determine what's happening with the credit cycle.
Okay, Gordon. So last question before I let you go. The dollar index has had a very strong rally since March. It bottomed out around 88. If it broke 88, it was going to go a lot lower, maybe to 79 pretty quickly. It's rallied very strongly. It's causing, I call it a wrecking ball to emerging markets and a lot of corporations and banks that are over leveraged. Dollar index right now, it's dropped below 95 to 94.54 when we're recording this. What do you think the dollar rally is going to last, or do you think that the dollar rally is sputtering out?
I believe we have a lot more to go in the dollar, longer term. We've got some short-term issues. There's pressures on Trump to do things. There's tremendous pressures on the United States from the emerging markets around the world and the other countries who are seeing the problem to get the dollar down, and they have the ability to do that. But at the end of the day, that's just another round of manipulation. This dollar will go stronger. Because what we have is a fiat currency failure going on right now, and the dollar is currently the strongest. The problem with the dollar, when it will reverse, and it will reverse and be hard, but we're not anywhere near it yet, is when we have the really beginnings of de-dollarization that's happening. You've got Iran, you've got Russia, you've got China, you've got India, you've got a lot of the countries emerging that are moving out of their use of the dollar. You've got the petrodollar that's now breaking down as they're now trading oil in other currencies rather than a dollar. There's not the same growing demand or requirement rather, for the dollar that there has been, in spite of there being a dollar shortage, which is another issue. And we have to get into a concept called the Triffin's paradox, but that's another issue. But eventually this de-dollarization is what will hurt the dollar. But we're a ways from that right now. So I think there's more strength. Yes.
Yeah, so, the stock markets, despite some of these things that we've talked about, the U.S. stock markets at least have continued to go up. That's in spite of, more Federal Reserve rate hikes that could break things. That's in spite of the dollar rally, which could break things, which could really hurt the global economy. And that's in spite of this quantitative tightening, which a month from now is supposed to ramp up to $50 billion per month. And, on top of this, Trump is running with these tax cuts. He's running massive budget deficits. So there's going to be record amounts of treasuries that the U.S. Treasury is going to need to sell in the not too distant future. But, the stock market doesn't seem to be caring about that much. It doesn't really care about reality that much now. So I don't know. We'll have to see. I'm tired of making predictions anymore because things just keep getting crazier and crazier. And then the rules.
The short term, it's about the pools, Jason. Right now, it's more that the shrinking pools are what's keeping it up. Okay, so
okay. Well, we'll have you back on again in the 3 or 4 months, Gordon, for more analysis of this, and we'll see because 3 to 4 months from now we'll probably have some type of answer about that $50 billion per month because the Fed has sold off over $250 billion on its balance sheet. Although selling 250 billion versus 4.5 trillion dollar balance sheets not too much, but we'll have to see if the other central banks, as they're claiming next year to start reducing the QE, we'll see if they do what they say.
The world is watching, quite literally, the U.S. midterm elections and whether Trump's tax code version 2 is coming, etc. So after November the 8th, we're going to see some, one way or the other, some significant shifts occur. So it'll be good time for us to talk.
Yes, and if he cuts taxes more, that might help the individual consumer, but then the U.S.'s debt will grow faster. You'd think that would hurt the dollar in the long run, but in the short term, who knows? Maybe the dollar rally will continue like you said.
One last point I'd make. I did some preliminary numbers a while ago, back of an envelope, and I looked at the tax savings that everybody got in America across the board in corporations, and then I looked at what Trump's proposed tariffs would be, the impact to the U.S. To U.S. consumers, both commercial and public consumers, and they were pretty damn close. They were within spitting distance. I also then tried to compare what a devaluation in the yuan, which is required, would be, and what our target was, and all those came out to pretty close within spitting distance numbers. Thought it was a hell of a coincidence.
That's interesting. So you think then China is going to do a massive devaluation in the next 5 years?
Right now, they don't want to. Typically, they did. Remember, August 2016, they did it. Well, remember, we went through this whole Shanghai Accord. But right now, they're trying to hold it up because in China, people don't realize 42% of their GDP is about capital formation. They can't afford to have capital flight. They need capital coming in, and it's not coming in if the currency's weakening. They've got to get it up. But right now, they're in a position where I think they're going to be forced, right, to an actual fact take it down. I think there's a significant devaluation coming in the yuan within. I think it's shorter than 2 years.
I think definitely within 5, but they may do multiple devaluations. But exactly. Yeah, I agree with you. They don't want to do it, but I think they're going to have to do it because that's the way they've been doing things. But the problem is their flight capital, like you said, and then the other problem is they have this enormous credit bubble, and then they have a speculative real estate bubble, which is absolutely massive. Some of the anecdotal stories I've heard of buildings that were just built in China and are becoming decrepit are pretty crazy.
I did a whole series of videos on China, and there's 150,000 state-owned enterprises. We forget they're actually a communist country. I mean, they're great capitalists, but all their corporations, most of them, are either state-owned or the money they get is free. And the whole world of dumping is something they don't seem to understand very well, or they do. So if you get inside them, there are massive numbers of zombie corporations in China right now. And they have to compete. They have to sell their products, and so lowering the currency helps that end of the game, but it's not what they need to really sustain that or stop that capital flight problem. So it's coming. I think it'll be one of the shockers that'll come out of nowhere, but we should have all anticipated it.
Yeah, plus the government owns 90% of the banks there, and a lot of the banks were forced to give out loans to municipalities and corporations that they knew couldn't be paid back. So one People's Bank of China official said in a newspaper there that he estimates from talking with his sources that there's 80% non-performing loans. But since China owns the banks, I mean, they could technically do bailouts, but I'm not sure how some of the people holding those bad investments would feel about that. Well, Gordon, you are a wealth of information. I enjoyed our discussion. I kept you a little longer than an hour, but I think our listeners will find value in the extra time that you provided us with your insights. If our listeners want to follow your work more closely, sign up for your newsletter. How do they
go to MATA, SII.com. We have a tremendous amount of free information, and most of our work we put out is also in video format. For the public. It's really an offshoot of the research that we're doing.
Please like this video. Share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.